over the past couple of weeks, more conversations about Fed pause. Not only that, but some people say to me they're actually going to start hiking again. Why do you see the Fed cutting in the first half of 2020?
Well, we have the below consensus outlook for the U.S. economy as a whole. We think that the U.S. economy may come close to stalling really in the first half of the year, and where the trade war concerns may be abating as we speak, and potentially they may not resurface before the US presidential election. I think they may be well replaced by concerns about the political outlook in the US ahead of the presidential elections. And discussions with clients have highlighted in particular the fact that Senator Warren's leading the field in the Democratic ahead of the Democratic caucuses, Iowa, New Hampshire, starting from early February and onwards, is a reason for a concern. In particular, the emphasis on protectionism on her side, weak dollar policies, but also emphasis on regulation and indeed fiscal spending that may have to be funded through higher taxes. So where at the moment investors, or for a long period of time, investors were fretting about Trump's populist mix of policies, of fiscal stimulus and protectionism, before long they may start worrying about a mix of policies that include protectionism but also involve some fiscal austerity in the US. So from that point of view, given that outlook, and indeed if Senator Warren does emerge as the front runner really in the Democratic field of contenders, chances are that may weigh on business confidence, that may discourage business investment, may even weigh on consumer spending plans early next year. So taken together with the still, I would say, scars from the trade war really that may linger on the US economy, on business confidence, we think that the Fed is not done easing just yet. Right.
And does your weaker dollar call hinge on that cut coming from the Fed, or is the dollar poised for a fall nonetheless?
Well, we do think that one important contributor to the dollar downtrend that we envisage later on next year is indeed the erosion of the currency's rate advantage across the board, courtesy of the Fed. Really, we do expect 2 rate cuts next year that are going to add to the cyclical headwinds, as we call it, for the dollar. They're going to lead to cyclical policy convergence between the Fed and other central banks, and ultimately make the dollar a less attractive carry trade across the board. On the top of that, we expect that the intensifying political concerns ahead of the US presidential election will likely impact the perceived credit quality of the US assets. And with that in mind, we think that currencies like the euro, funding currencies like the yen, may emerge as the biggest beneficiaries of a potential turning in the dollar uptrend.